Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
I thought I'd spend a minute on the Nobel Prize. We've been focused on the Peace Prize, but the prize in economics was particularly interesting this year, I believe, because it speaks about growth, about what the factors are to generate growth in markets. And it has been a conundrum for many thinkers, commentators, economists, as to why the US has broken away by so much when it comes to growth relative to Europe at this particular juncture. We know that the US had less regulation, more innovation, more of an entrepreneurial climate, and certainly up to now, more of an open approach to immigration and to growth, and definitely has outsourced some other labor around the world as part of globalization. So it'll be interesting to see if these trends now start to change and reverse, and what kind of a climate that creates for growth going forward. The three economists who won the prize, there is a summary of some of their thinking in the Financial Times. And some of the pointers, which I thought are just worth remembering, is that growth is often resisted. And they cite the example of during the Industrial Revolution, when in the UK, there was resistance to going into factories. The agricultural workers did not like to have structured days to work for anybody other than themselves. And there was initially a need to get workers into the factories, such that the factory owners had to recruit women and children to do the work. And it was only later that men became factory workers. So definitely resistance, the need for time for growth to actually take place. Clearly over the course, of the Industrial Revolution, we're talking about decades. That time perhaps is being compressed today, but it is important to think about having the time that growth normally takes. And in that case, being able to be patient about growth, not perhaps emerging throughout the world to the same pace that we would expect. It says it's cultural, and we've already touched on this, the culture of innovation, a culture of less regulation, less big government. This can be conducive to growth at times, and similarly an openness to growth. It is unpredictable, so we cannot necessarily forecast the future. There's been a huge demand to try to forecast the future around AI. And it has been very difficult to do, and that's normal. And this is perhaps something we need to remember when it comes to growth. And finally, it's not inevitable. So we shouldn't expect it to be necessarily flowing from the fact that growth has occurred before. We have to be asking whether the cauldron of influences and of circumstances is in place such that growth could occur. And I think it is an important salutary warning here that the prize is a warning about the future of progress. This chart showing that growth is not inevitable showed that the period of growth in 18th and 19th century Great Britain coincided with periods of greater openness, and a suggestion that the cauldron of new ideas and technologies was more important than simply build. And then there is the graph showing that 11 trillion gap in nominal terms between the GDP growth in Europe and the US, having started out at more or less the same point in about 2008 or 9, just how much that has diverged since then, quite